The year gone by was a very rewarding one for PB Fintech, the shareholders, and for the business. The company has demonstrated that their business model is solid, robust, and it is something which is future ready. The stock, which at the beginning of 2022 and 23 was in some kind of a disarray, has also made a majestic comeback. So what is the way forward for 2025? Will this growth and excellence the company has demonstrated, is this here to stay? What about AI and other disruptive factors which are at play and how they really could impact the company going forward? So to take that conversation forward, it gives me great pleasure to bring on board Yashish Dahiya of PB Fintech. So nice to have you back on ET Now. Thank you for joining us. Let me first extend best wishes for 2025.
Thank you. A very happy and healthy 2025 to everyone.
For a company which is sharing insurance, I'm sure the word healthy had to come even in a newer wish, right?
I would say healthy comes well before insurance, but yeah.
It's been a healthy year, 2024, for your shareholders, for the company. A lot of naysayers, a lot of your critics have been silenced by the kind of growth you've demonstrated. Do you think the growth is real? Growth is here, and growth is more importantly here to stay?
Well, the growth is always, at least in the past and in the present, real, because the customer has to, pay taking money out of their pocket, and that's a very hard thing for the consumer to do. So the growth is, of course, real. I think when I think about the outlook on growth, I think we are fairly confident of the near-term growth. Let's see how the long-term performs. But even when we talk about the long-term, we feel a 30% kind of growth over the next 5 years should be par for the course, and we should be able to deliver that.
Sector per se, if I look at the data which is coming from manufacturers, it is not growing in that rate, but you are growing. Is this largely because of market share gain?
No, we are growing, and we're not growing because of market share gain. We are adding new customers. See, what is market share gain? Market share gain is there are 100 customers out there. You used to take 10 out of the 90, and now you are taking 20 out of whatever, out of the 100. So you're getting 20 and the industry is getting 80, right? But that's not what's happening. We are adding new customers and are quite remarkable in the addition of new customers to the sector, both for health insurance, term insurance, and even the savings area. So we are bringing new customers to the sector, not taking share from anybody else. And the way that is personified is our media spends, our efforts in making new sales are ever on, and they don't take away from anybody else. They create new market. And thus, I think we are adding value to the industry rather than taking share from anyone.
What you represent essentially is a digital insurance space, and that's a very unique space. It's a space where the penetration levels are low, but looking at the advent of technology and what you have to offer as a product, I guess sky is the limit right now. What is the best way to look at the size of opportunity or the size of pond, as they say, for digital insurance in next couple of years?
I don't think you have to think about digital insurance. You have to think about insurance. That's number one. And I say that with confidence. Today, India is one of the best performing digital insurance industries in the world. Yes, we are a large contributor to that, but it's a very proud statement, right? That in digital insurance, we are ahead of almost every other country in the world. And in terms of percentage of sales that happen through the digital channel. Now, I think the entire digital channel will grow remarkably, and the industry will actually be a limiting factor for the digital growth, not how much consumers are willing to do digitally. And I think I would ponder there a bit. Our health insurance industry today is a $10 billion industry, or whatever we call about a 80,000, 85,000 crore industry. When you think about the United States of America, that is a $1 trillion industry. Same health insurance. That means 100 times bigger than us. And I think the US economy is 6 times bigger than us. It's maybe 7 times. So I think it does not behove well that we are 100th in size of health insurance, specifically when we have 1.5 billion people and they have less than 300 million. So we are more than 5 times the number of people with 100th the health insurance. So I think things are about to change in the next 20, 30 years, and health insurance will grow much more. And I think today that is the limiting factor in the growth of the digital business, not how much of the business can happen digitally. Like, I think a very significant part is already happening digitally.
You mentioned that 30% growth looks achievable.
I can't hear you.
Yeah, you mentioned 30% growth for next couple of years looks fairly, fairly easy. When you say 30% growth, are you referring to your core business growth, or this includes the new business as well?
No, when I speak of growth, I only talk about the core business growth, always. I never include the new business growth in that. And I've been quite consistent in that for the multitude of years.
If the business or the core business is growing at 30%, then what happens to the advantage of operating leverage? Will operating leverage start kicking in more and more like it has kicked in last couple of quarters? Because at 30%, your fixed cost is going to remain constant and benefits of operating leverage will start kicking in. So will we see incremental benefits of that kicking in every quarter?
Yes, without a doubt. But all I wanted to say was that's not the objective right now. I've always said we are like a 16, 17-year-old, which is what we are. And what that means is we are just a company or a student that's just about to finish school and go into college. We are nowhere close to being in a job. And even if we were in a job, we are in the first 5 years of a job. We are not in a position. So typically, if you look at a human being's career, parents put in money, then the human being, gets into a job, then builds a career. And at some point, they also start making significant money, right? And so we are nowhere near that point where we are trying to profit maximize. We are at this point trying to become stronger, learn more, grow faster. That is really where we are. And I've again been very consistent on that. That said, profits will come. They are, because as a business, we haven't done unprofitable business. And so what that implies is every time I do a transaction, we do make some money. And that money is only adding up as we do more and more transactions. And yes, our fixed costs will and should always stay lower than fixed cost growth should stay much lower than our revenue growth. And even in the revenue, we should have some leverage. Because as we get further down the years, the brand confidence increases, our people's confidence increases, the conversion rates improve, and we have been seeing all of that.
You have one non-core business, which is PESA Bazar, where you've invested. And the second one is an investment in a healthcare venture where you're looking at expanding. Could we be looking at more news on new investments and non-core businesses from PB Fintech this year?
I don't think you would hear more news, but you would see hopefully some action on the healthcare side. On PESA Bazar, the entire credit and unsecured lending area has tightened a bit. So PESA Bazar has effectively started a new business in secured, which did not exist. The good news is secured is picking up, and secured in terms of overall disbursals has now overtaken the unsecured part. But the unsecured has taken a big hit. And also in secured, you make much lower margins. So I would say, but it's remarkable that within 1 year, the secured business has built up. And so I feel confident about that area as the industry stabilizes again and starts to grow again. I think PESA Bazar is very well poised to take up an opportunity there. As far as the healthcare venture is concerned, I think PB Fintech would be an investor in it. And maybe PB Fintech would have somewhere between 20 to 25% stake in that venture as we start to thrash out the details of the other investors.
Your commitment of $100 million maximum, does that stay, or that could vary going forward as the business grows?
Sorry, I didn't hear the first.
No, your commitment, the number of $100 million apparently is what I'm reading you've given as a commitment. Maximum commitment to the healthcare venture. Will that stay or that could change depending on how the way the business progresses?
Yeah, I think we are going to end up investing a lot less than that, is my view from a PB Fintech perspective. Overall, the investment in the venture could be much higher than that. But PB Fintech itself, as I said, is going to take. So, what's happened is the board has given me approval to negotiate with other investors. So I'm in the middle of that now. And what's coming out is that PB Fintech will perhaps have a 20 to 25% stake. At some level, it'll either be an associate company or not even be an associate company of PB Fintech. And I guess as that evolves, PB Fintech, from an investment perspective, maybe around half that number that we spoke about. But it has the ability to invest in the future. But I think what's clear is that PB Fintech is not there because of its capital. PB Fintech is there because of what it brings to the table in terms of consumers. And I think PB Fintech is also there because of the benefit it receives, not because of the money it can put in. There will be investors who will put in perhaps 2 to 3 times more money than what PB Fintech puts in at the first stage itself.
Yatish, in the insurance or the life protection business, you are the market leader and you have an enviable growth. But when it comes to PESA Bazar, you'll appreciate the spirit of my question, which is that you are just a NBFC which has to again compete and has to innovate with the existing set of NBFCs. So what is your view on PESA Bazar? Because it is right now sucking in capital, a lot of mind space and a lot of attention of the top management. How large PESA Bazar could grow for you?
So first of all, it's not taking in capital from PB Fintech. It's actually returning capital to PB Fintech. It's a profitable entity. Its profits might be large or small, but it's a profitable entity. It's a cash generative entity. Number two, yes, it does take mind space. There is no doubt about it, which is our job. That's what our minds are for. And I think at a fundamental level, big believer in PESA Bazar. See, insurance is not the only sector that requires a marketplace in India. And within financial services, I think other areas do require it. PESA Bazar kind of cornered itself by just getting into unsecured lending. As it's moving into secured lending and a few other products like investment categories, etc., I think it would do quite well for a consumer to have a digital ally who would help them in terms of their, whatever information a consumer has. It would be good to have that. Now, lastly, I wanted to explain why PESA Bazar is different from any other NBFC or any other DSA. See, PESA Bazar, today, any NBFC, any DSA, any bank is able to cater to 30, 40, 50% of the market. Nobody says I can cater to the entire market because there are different segments of consumers in the market. There is high-end consumers, there is low-end consumers, people who are barely able to get credit. And PESA Bazar works with 100 plus NBFCs and banks to ensure that the entire market is covered. I think that is the strength of PESA Bazar. And I think in that, it is quite unique. There is nobody with that width of choice and the number of, and it's hard. When you work with 100 partners, it's hard because you have to take care of every partner and every partner is unique. But it's worth doing because for a consumer does not know which partner is going to take care of him today. There are some consumers who can be addressed by the large banks. There are some consumers who get addressed by the NBFCs. There are some consumers who get addressed by the fintechs. Today, PESA Bazar is suffering because the fintechs and the NBFCs are suffering, but the large banks are doing okay. And I think sometime in the future, it might benefit because the large banks might still be doing okay. But even the NBFCs and the fintechs might get space to breathe and grow. So I think it's not feasible that a market like India stays credit starved for the long term. And thus the need of a marketplace. We've seen it work very well in the US with Credit Karma, Intuit. And I think the one thing I would say is PESA Bazar, like Policy Bazar, is becoming quite unique as the only survivor in that area.
If you like this video, then like, share and subscribe to ET Now.